Hey guys, Killstokes here. Welcome back to another episode of the Trading Coach Podcast. What if I told you that I was a victim of one of the biggest frauds in US futures history and lost all of my money due to an elaborate scheme from a scammy broker? And don't worry, this podcast is not about throwing a pity party for yours truly. Rather, I want to use my experience to teach you some very valuable lessons so that you can be better prepared than I was. So, let me tell you about one of the craziest stories in the history of the trading industry. It's the story of, and I always butcher their name here, I think it was Peregrine Financial Group, we call them PFG best, and how really more than about $215 million of customer money was stolen over a 20-year period. And the thing that makes this story so crazy isn't just like the massive amount of money that was stolen, but again, the fact that this fraud went on for over 20 years and how this company was able to convince regulators and auditors and customers that the money was sitting safely in the bank when it really wasn't. So let's break this down, right? PFG was a futures brokerage founded by Russell, I think it was Wazendorf, something like that. Russell Wazendorf Sr., or something of that sort. And like all brokers, right, customers would deposit money with PFG so they can trade futures and options and, whatever. So like other regulated brokers, PFG was required to keep customer money separate from the company's own money, which is something called having a segregated account. In simple terms, here's what it means, right? If you were to deposit $100,000 with your broker, that money is supposed to be sitting in a separate account there for you in case like you ever need it back, right? Your broker isn't supposed to take it and use it for other things. But that's exactly what happened at PFG. Wazendorf Sr. was stealing customer money and using it for other purposes while creating fake records that made it look like the money was still there. And this is where things get really, really crazy. So let's say PFG was supposed to have 200 million of customer money sitting in the bank. In reality, they probably only had a few $1,000,000 that was actually there. But the records that they had would show a full 200 million. How do you ask? You see, Wazendorf created these fake bank statements. He would forge bank confirmations. He would manipulate financial records, and he would even use fake mailing addresses that appeared to belong to the bank. So when the regulators or the auditors or whatever wanted to verify the amount of money that PFG had, they weren't necessarily talking directly to the bank. They were getting information that Wazendorf had essentially created himself. And I want you to think about this for a second, right? The regulators would say, hey, we need confirmation that the money you say is in that account is actually in that account. And Wazendorf would basically create the confirmation saying, yeah, here's the money right here. Meanwhile, it wasn't. And he would even do things like Photoshop and print out certain things to create fraudulent bank statements. And somehow this went on for about 2 decades, right? It's wild. But eventually, as technology caught up, the system changed, right? The National Futures Association changed the way they verified customer funds and began using electronic confirmation rather than relying so heavily on the old paper-based process. And this created a problem for Wazendorf because now he couldn't manipulate the verification process as easily. And now the numbers didn't match. And PFG was claiming that it had hundreds of millions of dollars in customer funds, but when the bank account was checked, the money simply wasn't there, and everything began falling apart. Finally, on the wonderful day of July 9th, this would have been, 2012, I believe, Wazendorf attempted suicide outside of PFG's headquarters and left behind a note admitting to the fraud. The following day, regulators shut down the company. So yeah, during that period, a lot of crying and screaming and shock and confusedness and other things, kind of like an empty, dull feeling. I don't know if you guys have ever had anyone pass in your family, but that's similar, like hole in your heart when someone unexpectedly passes. Like, I don't expect it. I don't really know how to feel or what to do. I can't do anything about it. I wish I could do something about it. And you're just like existing. So all of that was me. But let's get back to the story because I don't want to talk about me. That doesn't serve any purpose here. So after the failed attempted suicide attempt, Wasendorf pleaded guilty to, mail fraud, embezzlement of funds, and making false statements would be fraud or, that type of stuff, right? And in 2013, he ended up getting sentenced to 50 years in a federal prison and ordered to pay back roughly $215.5 million in restitution. I did get a little bit back, not enough to be happy by any means, but we all got a tad bit back. But during this whole deal, as you can imagine, thousands of people were affected. And this is the part of the story that I think traders really need to pay attention to, because when you're trading, most people think risk is just about, hey, how much can I lose on this trade? But there's another type of risk that doesn't get talked about nearly enough, and that is your counterparty risk, right? You can have a great trading strategy. You can have perfect risk management. You can follow your trading plan to perfection. You could do everything exactly the way you're supposed to do it, and you can still get hurt if the institution holding your money fails or commits fraud. And that's what makes this PFG story so important. These customers, including myself, weren't doing anything wrong. We weren't blowing up our accounts. Well, I'm sure some were, but most of us probably weren't blowing up our accounts. We weren't over leveraging. We weren't revenge trading, right? The problem was that the money that we thought was sitting safely in our broker's kind of account just wasn't there. And that's why choosing a broker isn't something you should take lightly, right? Just don't ask, hey, what are your spreads? Or, hey, what type of leverage do you offer? Or, what's your preferred trading platform? You should be asking things like, who regulates you? Or, where is my money being held? Is customer money segregated? What protections are available if something goes wrong? And perhaps most importantly, who is actually holding my money? Because PFG is a perfect reminder that there are risks in trading that have absolutely nothing to do with the markets. Again, you can manage the market risk perfectly and still have institutional risk sitting in the background. And that's one of the lessons I want you to take away from this story. The other lesson is this: no matter how safe we are, no matter how much research we do, some things are just out of our hands, and we have to be okay with that. After all, we can only control what we can control. But a crucial part of risk management means also not having all of your eggs in one basket. In the financial world, we often look at this as being diversified, or showing diversification, like when you trade a portfolio of assets instead of just trading everything on a single asset. But we also need to remember about account diversification as well. As you start to grow your trading account to a number that is of great significance to you, whatever that number may be, you may want to consider shifting to a model where you have multiple accounts. Now, this is also going to be very, very helpful if you're trading different trading strategies that maybe have conflicting signals, or maybe you're a swing trader and a day trader and you don't want to be stuck in a swing trade for, a month and not be able to day trade that same pair because you can't be in more than one trade at once. But from a risk management perspective, if something similar were to happen, and again, I don't think something like this would happen again with the technology and the amount of oversight that we have in this day and age, but if something like this were to happen where an account or a brokerage goes under and for some reason loses everything, at least you wouldn't lose everything. You would just lose half of everything, or however much you have in that account. The point is, you would still have money in another account with another broker, and that means you would still have a chip. And if you still have a chip, you can still have a chair. And most importantly, you still have the skill of trading, which means you can still build yourself back up and recover. So that was the main lesson that I learned from this unfortunate situation, we'll call it. And like I mentioned at the beginning, yeah, it sucked. It sucked a lot, and I'm still scarred from it. But at least I can now pass on this experience to you so that hopefully you don't have to go through it as well, or rather, if you do go through it, you know how to protect yourself. So I hope you enjoyed the story, and I hope you're enjoying the podcast. If you are, do me a favor, leave a rating and a review. It takes a second, but it significantly supports what we're doing here. Follow, that way you don't miss future episodes. And of course, if you want more video related stuff, my tier 1 members are yelling at me for not making this a video episode. But if you do want more video related stuff, head over to the YouTube channel. I usually post about 2 videos a week and daily quick tip videos as well. All right, until next time, plan your trade, trade your plan. Take care.